Melissa Blevins with melissablevins.com, your personal finance coach for the free-spirited nerd. You probably have been thinking about buying a house if you clicked on this video. I wanted to kind of go over a couple of the different loan programs and the differences and whether or not you should buy a house at this particular point in your life. So let's get started. So one of the loan programs that is pushed to first-time home buyers is the FHA program. Because it's a low down payment program, you can have a pretty low credit score in order to potentially be approved for an FHA loan. But let me tell you the disadvantages to the FHA loan program and why I would never ever recommend this to anyone, okay? So the FHA loan program is a program that requires a minimum of 3.5% down payment. It does charge mortgage insurance, which is called PMI, private mortgage insurance. And that insurance just protects the lender in case you default. So if you are making payments and then all of a sudden you decide you want to stop making payments, the bank will foreclose on you and they will get their funds for you defaulting. So it really doesn't benefit you to have PMI or to have mortgage insurance on a loan. It only benefits the bank and it actually makes them money. So having PMI on a mortgage is something you want to avoid at all costs if you can. The FHA loan program has the highest cost PMI out of all of the other programs out there. And it doesn't drop off after you've paid off 20% of the loan to value. So let's say you bought the house at 96.5% of loan to value because you put 3.5% down. Once you get it paid down to where you have 20% equity in the house, they don't take the PMI off on an FHA loan. It's there for the life of the loan. So there's literally no benefit to doing a FHA loan. And if you follow Dave Ramsey, he would tell you that you are too broke to buy a house if you can only do an FHA program with 3.5% down. So that's one of the reasons not to do an FHA loan. Another loan program that's widely used across the US is called the USDA or Rural Development Loan. The USDA loan is a 100% loan program based on income. So if you meet certain income and eligibility requirements and credit score requirements, you could potentially be approved for 100% loan to value of a home, meaning you don't have to take any money to closing. Sounds awesome, but you have no equity from day one and you're inviting Murphy to visit you. You're inviting the hot water heater to break, the furnace to break, the air conditioner to break, the septic system to back up. Now the USDA loan does have a lower guarantee fee, which is very similar to the mortgage insurance premium I was just talking about on the FHA loan, but the USDA guarantee fee is also for the life of the loan. It's not really private mortgage insurance as the FHA loan is. It is very similar, but the way they've worded it has basically made it for the life of the loan as well. So you can't get rid of that either. You never want to do a USDA loan unless, well, I really can't see the benefit to doing a USDA loan. And I will say I have done a USDA loan and I shouldn't have at the time in my life that I did. So then you have the VA loan for veterans. And it's very similar to the USDA program in that it's 100% loan to value. So you can finance the entire cost of a home, including the VA funding fee. So all of these have a different name. So one of them is PMI or mortgage insurance premium, and the other one is a guarantee fee. And then now you have a VA loan funding fee, which is an upfront fee that you pay for the VA in order to have the loan. I really don't see much of a benefit to the VA loan either because, again, you're setting yourself up for disaster by really putting 0% down again. And you wouldn't, if you can afford to do 5%, 10%, 20% down on a conventional loan, why would you use a VA loan just because you're a veteran? There just isn't enough benefit there for that. So the last loan product I want to talk about is the conventional loan product, which is the absolute best loan product that you can get. And you can put as little as 5%, sometimes even 3% down on a conventional loan, but I would use caution if putting less than 5, 10, 20% down, because again, you're putting yourself into a position with little to no equity and inviting Murphy to come visit you. Sure, the interest rates on loans are low right now. Mortgage rates today, I believe, are around 4% for a 30-year mortgage and around 3.5% for a 15-year fixed. So they're really great rates, but you don't want to finance everything you can into your house right away. You want to be able to put down as much as you possibly can. You want to be able to put down as much as you possibly can and finance it for the shortest term possible. Because if you pull up a loan calculator online and you look at the amortization calendar, it will show you how much you'll pay in interest. It's usually at least double what you paid for the house. So for a $200,000 house, you might end up paying $400,000 on a 30-year fixed mortgage. That's insane. So do yourself a favor, do your homework. I also want to tell you really quickly about a way to avoid PMI. Some local community banks and credit unions will offer lender-paid mortgage insurance, where you basically buy up the interest rate 0.25% or 0.5%. Check with your local bank to see what their options are. But let's say the rates today are 3.5% for a 15-year fixed rate. So you only have 10% to put down on the house. Well, typically if you have 10%, you're going to have to pay PMI. However, you can talk to your lender and see if they offer lender-paid mortgage insurance. And instead of paying 3.5%, you might pay 3.875% interest on the life of the loans, but you avoid the PMI. So it really depends on how long you're going to be in the home, how long you plan on being in the home. And remember that usually when you say that you are going to be in this house for the rest of your life, that is absolutely not true. So everyone says that this is my lifelong home. No, it's not. I can tell you it's usually not. So I hope you guys have an awesome day. If you found some value in this video, please give it a thumbs up and a quick share, because there are so many different loan programs out there, and I want you to be as educated as possible before you even sit down with a loan officer. So have a great day, and thanks for watching. Don't forget to subscribe.